And it turned out, this is the third thing that's important, what drove these premiums to increase is that another COMEX market maker, this is not JP Morgan, this is Standard Chartered, is buying up as much refined wholesale 1,000-ounce silver bars as is on offer.
Today's video is sponsored by Miles Franklin. To get this week's special of silver maple leafs for only $3.49 over spot, email arcadia@milesfranklin.com. And now on to today's video. Hello there, my friends. Chris Marcus here with you for Arcadia Economics. And I'm darn excited today because, I'm gonna say I've been fortunate to speak to a lot of cool people in the last couple of years doing this, although walking around listening to an Andrew Maguire podcast this morning, and I'm like, wow, that's pretty cool that I can ask my own follow-up questions and talk with you every month, Andrew. Certainly, it's quite a book or a movie one day of everything you've gone through, hopefully. So either case, great to see it. And how's everything going today?
Well, Chris, number one, it's great to be with you, but let me just say, it's a privilege for me to come on your channel. You've done a lot for the industry. You've done an awful lot, and you're really making a big footprint. And as I say, we were just talking a little while ago, I'd be very, very proud to introduce you to anybody in my circle when you do get a chance to travel. We're all locked down right now, and the UK, we're locked down. I can't even go to my office in Liechtenstein. I can't even hop on a plane without being forced to be locked in a hotel room for 10 days. So I don't fancy doing that. So anyway, but this will all be over soon, and we'll all be visiting each other, Chris.
We'll find a way to get Silver Cruise going one of these months, hopefully sometime next year. I do really want to find some place to have an event where people that, again, I respect, for anyone who has concerns, but people to actually get together in person, and we'll look forward to that. And certainly as we're looking forward to hearing your thoughts on the silver market, if I may start, there's something I keep meaning to ask you, and then we talk about so much, but I'd love to dig in. You've mentioned a couple times this year about the reset. And I guess I've been curious. Certainly we've heard for decades, or Clues or Economist Magazine, reset. Is it something that you are able to say that is planned, that you can see on some level specifically, or any context you can put around that? We have Davos talking about the Great Reset, so there's a lot of things out there, and just would love to hear more about that.
Yeah, and I think it's really good. You've got a lot of people that can provide very good color and to what you're talking about there. I think what we need to do is the reset. Yeah, we've even discussed levels where we think it can't go beyond before it is reset. But when we're talking about specifically gold and silver, and obviously the reset involves a lot of other things, but basically we're talking about gold and silver and how that acts. I think one of the things that we are looking for this point of a reset, it has to be, it's the paper to physical equation. And you can, look, there'd be no need for a reset of a gold or silver price if there was no physical market at all. i.e., we could be trading at any level. If that was the case, COMEX could technically go to zero, well, 1%. But we know that's not the case. So I think what we try and do here is to bring in, give you the wholesale market. I think it's the physical market support and resistance levels, which is what we're looking at very closely. And also, actually, we've got some very important wholesale market feedback to report, which is all part of the jigsaw of information that tells us ultimately when this is going to happen. Now, obviously, there are a lot of pieces to this jigsaw, and people are looking at the action this week and last week. And so I think, we need to step back and get involved in a 10-minute chart. You're going to think all hell's broken loose, draw back, look at a daily chart, look at a weekly chart. There's no drama. I mean, it's what we're seeing is really illegal in the sense that there should not be allowed to be such enormous position concentration. But essentially, there's limitations to where the price can be pushed. And then many of your guests have really observed that COMEX-centric gold and silver prices are grossly lagging extremely strong fundamentals. This confuses a lot of people. And really what we're doing is we're seeing gold and silver coiling heavily under these suppressed gold and silver prices, coiling for a rally. And it's just where a lot of us are saying, well, where's this rally? Because, from a wholesale market perspective, this is overdone. And now we did anticipate that it would have to commence directly after. And if you remember, we talked many times about Bank of International Settlements options expiry. And the last one was the 30th of October. Well, it's really was no coincidence to see gold starting to rally after that. And obviously we've had some pullbacks since then, but it's important that's why I think it's important. If only there was a simple answer, but I think people would probably appreciate looking at the bigger picture, then we can drill down any questions you want. But this is a really good time to explain some really notable increases in the Bank of International Settlements gold leasing efforts. Now, a lot of people, GATA have been talking about this, and I would agree with GATA's consultant, Robert Lambourne, that likely the current level of gold swaps undertaken by the Bank of International Settlements has risen to its highest level in 20 years. Really, I think that's a good analysis. Now, the BIS uses bilaterally settled unallocated gold in its swaps. People think it's physical, but it's not. And they just swap this unallocated gold with the bullion banks, which means no physical bullion ever leaves their site account. And then we'll look closer at the Bank of International Settlements shortly. But first, it's important to discern that this central bank of all central banks, gold swap liability is being laid on the taxpayer insured commercial banks. And it's this liability that will ultimately be squared with a keystroke for an inevitable gold price revaluation, which is part really of this great reset. Now, from what we continue to see as wholesalers, we're absolutely certain that there is very little physical bullion backing massive volumes of undeliverable paper market supply. So the house, which is run by insiders, which we mean, of course, the casino operators, they profitably rig the ranges, but this is absolutely key. They also seek to front run paper market dips to quickly profitably buy back these bearish bets before they enter competing physical support levels. Now we can look at those perhaps a little closer in a minute, but ultimately paper market prices can be demanded for delivery. And it's these levels which over time have been stair-stepping ever higher. And these are the exact levels that limit the insider-driven activity, which is also part of answering your question as to where that reset will be, because there comes a point where those lines simply have to cross. So yeah, Chris, we've been studying the similarity between the March bottom and where we are, what we're really evidencing now. Although slightly different, it's coming about in a slightly different way. The paper to physical divergent similarities that forced the EFP blow up in March are reaching absolutely notable extremes, certainly from a wholesale market perspective. Now, the exchange for physical mechanism allows COMEX paper gold positions in the US to be squared in the 10 times larger over-the-counter unallocated gold market in London. However, as was evidenced when this black box exploded in March, this really relies upon a technically deliverable COMEX contract being paper squared with an unallocated, fractionally held gold foreign exchange contract, or vice versa for that matter, especially with the backwardations we're seeing vice versa right now. But as a result of this paper to paper trade, which is all it is, it's once more attracting arbitrages. Now, the grossly divergent paper dictated prices we've evidenced for the last 8 weeks. If we look at the charts, you can see that gold and silver for the last 8 weeks have been almost flat. I mean, silver's been trading in a dollar range for 8 weeks. That's implausible and impossible. But what's happened as a result of that, really the pricing has reached what I think is dangerous levels for the insiders. Now, the driver to contain the paper price was originally focused on defending in gold the Bank of International Settlements options expiry bet that was made, good God, probably 12 months ago, 8 months ago. And as suspected, it was aggressively defended into the 3 o'clock UK time expiry on the 30th of October. And as we said, it was no coincidence. As soon as that was settled, the first short covering bout was triggered. And since then, we've evidenced 2 major capping events culminating in gold and silver threatening to break out this week on Monday, following through from a very large short squeeze on Friday. Now look, clearly vaccine hopium was used as a cover to incentivize a massive risk-on rally. And in this algo-driven market, the machines took over, dumping safe havens and racing into stocks. However, we think the machines have overdone it and have put gold very close to Chinese and Russian central bank buy levels, which were front run by a few ticks on Monday. Now, if we saw gold trade under 1850, and bearing in mind that it's backwardated to spot, so even though it may have breached 1850 on the COMEX charts, it never breached 1850 on the spot chart. So this is important to know these levels. So there has to be certain limitations. Now, however, paper market options defense, it's really reliant on no one asking for delivery of the underlying bullion. And this is what we're getting to. In reality, just like in March when they overdid it, real bullion prices have become far too divergent from the current paper-driven price. Now, so similar to the market action, this has loaded the spot index hopper, where we see lots of people buying spot to take physical delivery, to the point that the delivery demand on the over-the-counter paper positions once again threatened to pop the EFP bubble. Now, if gold and silver continue to be suppressed below very strong supply-demand fundamentals, it's going to pop this bubble. Now, as we outlined, I think, the last time and the week before, at least, and the last 2 times ago, I think, although the conservative trading banks withdrew from utilizing the EFP conduit, some of these very aggressive trading houses have once again geared their algos to game this EFP arbitrage window. And this has in turn drawn in other algos, and algos herd in to trade what looks to be working, but they have no concept of the physical market. And basically, as I say, 0 or 10,000. It really is irrelevant to a machine. However, given the footprints and factoring in a yet to be realized supply disruption, we see a real risk that this divergent arbitrage trade that we see some of these more aggressive guys jumping into blows up again. Now, only here in November, there's far less real market liquidity than there was when the March EFP bubble popped. So furthermore, now this is something. There's 3 things probably that no one's actually heard about. This is one of them. On Monday of this week, Argo Harass sent out a warning letter to clients advising of an imminent production slowdown, requesting orders to be pushed in within the next 24 hours, or you ain't gonna get any chance of getting them filled. And I'll just quote, I've got the letter here, quote, I'll just quote you one paragraph. Quote, the recent surge of infections combined with the massive requests we are receiving these days have quite a substantial impact on our performance. We are also forced to strengthen the current safety measures even more, obliging us to carry on with skeleton staff. End of quote. Now remember, the last time physical gold supply was rationed, which is essentially what this is saying, into strong physical demand, which we're seeing now, as we did in March, this was a cocktail that blew up the EFP conduit. So, this is important. Now, this explains one other thing this week, and this is the second thing. Banks received banks in Europe and those that we work with received a veiled warning from US COMEX brokers, and let's just name them. I didn't want to piss them off, but basically UBS is the US COMEX broker. The warning came from them, and I believe from one or two others, not to take delivery of cheaper COMEX gold for their clients or risk being blacklisted. Now, the last thing you want to do is be blacklisted on the COMEX. But all of this defensive stance does is to reveal a weak hand, and the sharks are once again circling. And what this is telling us is that the COMEX is scrambling to avoid a massive December physical delivery accrual. And we know that a lot of our European banks and a lot of Asian banks that we deal with are saying, look, you've sucked all this physical into your exchange. We can't get it. You've tightened the supply, increased the premiums. We're coming to get it. Now, basically, what this is going to do is undoubtedly the fact that they're actually defending it in such an aggressive way. It's really going to undoubtedly expose just how rehypothecated current registered inventories and even this current cocktail, it's such a bad mix. They're clearly unable to fulfill these December contracts. Now, chances are this is also happening in silver, because we have banks now saying, look, if we can't get delivery, let's explore going through an AP, and let's explore the costs related to actually taking delivery in the SLV. So it's becoming, they're really being a target here. Now look, this is a major issue and begs the question as to how does this fit into, for example, a regime change, which we seem to be going through politically. Now, look, who knows? This election is deemed to be over. Well, but look, this uncertainty, it likely drags on to at least December the 8th, when the Electoral College meet. However, whatever the outcome, it doesn't matter. Gold and silver as a store of value are grossly undervalued in fiat terms. Every liquidity provider is anticipating much higher prices and will be pricing accordingly into a series of very strong upside stair steps. These are the stair steps that we're going to kind of look at, but we evidenced interference this past Monday. But such bullish drivers will see long-standing technical resistances fall to these strong supply-demand fundamentals. So in other words, generated paper supply will have to be hedged with physical, or the EFP bubble will pop. Now, we're already evidencing deep backwardations in December to spot gold spot. And these discounts and tightening ration supply will not be ignored by European and Asian banks. So let's work out the sums there. If we see a $2 backwardation in December futures, that makes it extremely attractive already. And that covers all of the shipping costs and actually allows you to get the physical that you can't buy anywhere else, that's being rationed. And you actually, it's cheaper in the sense because there's no additional premiums attached to this. However, when we see, like we did today and a couple of yesterday, $3 backwardations, that is just irresistible. I mean, you're not just talking the $2 that squares your delivery costs. Another dollar of pure profit, pure risk-free profit. Bear in mind, these guys are professionally hedged. These are professionally hedged positions. So taking physically delivery, and you've still got a full dollar on millions of potential ounces. This is a huge profit center for the banks. This is absolutely unbelievable that this actual backwardation has not popped yet. So quite clearly, there is a real need to defend this price. And so, this is just really to explain the backwardations. So this is why we see the COMEX market-making banks scrambling to import as much physical gold and silver to meet delivery demands to avoid a delivery default. which if everyone goes for December delivery will be a default. Now, this was the plan, but refiners, and we're just saying now, the other side of this equation, the refiners are now rationing supply. Well, they didn't forecast that either. So, you know, sometimes you run into, maybe there is a God, eh? And this is now beginning to be particularly evident in silver. Now, if you remember, we broke some news about China had become a buyer of silver. But last week, more importantly, wholesale silver premiums tripled for fresh orders for the wholesale market. Now, I know that you have Andy Sheckman, who's a very big, who's obviously, you know, very, very, very well connected with silver. And I'm sure if you ask him about it, you'd probably see the same thing. But from a wholesale market perspective, when we go and buy 1,000-ounce bars, we have sources where we can buy maybe over 2,000 tons a year, and these sources were suddenly have raised our what we make commitments. We have a minimum amount and a full amount. So we have a minimum and maximum amount that we commit to, and then basically we then seek to take delivery at X over spot, and it's usually quite small. That tripled last week. And it turned out, this is the third thing that's important, what drove these premiums to increase is that another COMEX market maker, this is not JP Morgan, this is Standard Chartered, is buying up as much refined wholesale 1,000-ounce silver bars as is on offer. And when you factor in the delivery and transportation costs to the US, this is at a very large premium to spot. Now, what's patently clear here and completely unreported is that every single ounce of silver production is now being aggressively competed for. And believe me, this is a source that we thought was our own, and it is not, it had to be sought out, and it took quite some finding for them to find it. And now they've literally decided to literally ask for every single ounce to be delivered, taking all the production that they can get. Obviously, there are other clients, and we're one of the clients, and we have other clients who we know are buyers of this production, but this is enormous. So when somebody comes in and says, we'll buy everything and we'll pay you a premium, obviously, you'd be crazy not to take that premium. So this has upped the wholesale premiums, and it's also tightening supply for silver. Now, as more participants seek to cash in their casino chips for the underlying physical gold and silver that these chips purport to represent, the house is scrambling to add more physical gold and silver backing these casino chips. Now, the COMEX has worked itself into a catch-22 situation by scrambling to restore credibility after this EFP conduit blew up in March. They've raided global supply to back up increasing delivery demands. So by doing this, it's tightened up global physical supply. That's fine if this was reflected in real supply demand fundamentals, but it's not. And this is why the COMEX, I mean, the COMEX was never designed to be a physical market. It was never intended that this would happen. Now, what has happened, and this was purely, they brought this physical in to just restore some form of credibility after that big blow up. Now, what's happened is that the house has continued to utilize position concentration to perpetrate this insider run game, albeit backed by a higher percentage of bullion, which they've been importing. And so it's, in other words, a little bit more bullion backing each chip. But by tightening global supply outside the casino, it's raised the physical market premiums to the point that the only source for cheap physical is the casino. So chips are being purchased not to play the casino, the COMEX paper game at all, but simply to convert these chips into available physical at a massive discount to real available physical supply. So as we've been highlighting since March, we've reached a point where we are evidencing the COMEX in the crosshairs as a source of delivery. Now, these paper-centric futures contracts are being locked in for real physical delivery from outside the casino. It's an important point because a lot of, most Americans US citizens have to trade the COMEX. They cannot trade outside of the COMEX other than a physical purchase. So they can't trade the over-the-counter markets. Now, we saw this outflow, evidence of this historical non-delivery month of in the historical non-delivery month of October. If you remember, we saw an unprecedented 109 tons of COMEX gold chips were tendered for delivery, which was undoubtedly the cause, and I'm almost certain, of this Bank of International Settlements attack into the month end at a week ago. Now, we also evidence competitive futures longs also being demanded for delivery in November. And there's currently over 15 tons that are being requested for delivery in this nondescript contract. I believe there was only 1,500 contracts ever open in this contract. And suddenly we got 15 tons, like nearly 5,000 contracts delivered. Now, but what's this? But what this confirmed is to us is that the intent to convert massive December GC long contracts for physical delivery comes from the Asian and European banks. Now, these contracts will come into the crosshairs for physical delivery in just 8, by the time we're doing this, 8 trading days. Hence the warnings I've just mentioned. So we continue to draw attention to the fact that these orders for physical gold are not speculative margin positions that can be chased out. These are professionally hedged positions seeking physical delivery for bullion that is globally unavailable anywhere else for immediate delivery at a far cheaper price than it's on offer anywhere else. And this is not just about price though. This is about physical safe haven demand coming from a multiple of global sources seeking actual physical delivery that they can actually get now. So price raids in the non-delivery paper markets create this illusion. And if you look at the chart and you see, look at this illusion, there's a lack of demand for physical gold. But they're reliant on the paper gold contracts not being demanded for physical delivery. That what we're trying to say to you now is to everyone is they are being sourced for delivery. And yes, we can feel that there's some dirty games going on. How dare you take delivery? We'll blacklist you, etc., etc. But there's too much profit to be had. Now, the warnings to not dare to take delivery evidence to really, what is it evidence to me? It evidences a weak hand, a definite lack of credibility as the COMEX illusion becomes exposed. And the sharks will begin to circle. I mean, yes, very short term, the house can refuse to let you cash in those chips for the gold and silver they represent. But such a refusal will commence an outflow of COMEX liquidity as this open interest moves to physical venues, albeit maybe at a higher price. Though the last thing that the COMEX wants to see is an exit of lifeblood liquidity. If this outflow was left to run, this ultimately exposes the COMEX to another EFP blow-up, which is why we've been talking about it. But this time there's razor-thin liquidity, and this time a possible default. So, you know, more immediately, and this is really, a lot of people say to me, yeah, but well, how does this affect us right now? And what we've evidenced this past election week was the confirmation of a higher stair step for gold and silver to rally from. And actually, that's actually been revalidated this week and again, even as late as today. Now, the rally from the exchange for physical conduit, when it blew up in March, what it did, if you remember, if you take up a chart back to March in gold and silver, now, basically gold rose 638 bucks into the 2089 August high. And in silver, it rose $18.28 into the 29,915 highs. And we're talking futures here. So maybe a little bit of difference in the spot. But now, as we identified in August, we evidenced very aggressive Bank of International footprints appeared on Monday, August the 10th, stepping in to block a momentum generated rally that would have established stair-step support at 2000, which in turn would have undoubtedly triggered a short covering move into the estimated 2,500 gold price reset level, which is, we talked about this quite a few times. Now, but as we noted at the time, officials were not ready for the reset. So on the following Monday session, just as large momentum driven follow through buying threatened to take out the Friday 2089 high, they stepped in to block this with a massive sell program commencing at 2060. That's where it kicked in from. Now, obviously, it was very important because we actually we saw this coming in, and the footprints told us this was official in nature. So by the September the 24th, with the speculators wrong-footed and puking up longs and adding shorts, which is exactly what the intention was, a good percentage of the short liability had been laid onto the algo herd by the insiders. And insiders would ideally have liked to continue to expand undeliverable paper supply and keep it going, but gold ran into very large sovereign and competing central bank physical delivery demands, which halted it. Now, this stair step was cemented and not revisited in silver futures, but both GC and SI have been aggressively capped. But notably, despite generating fresh algo-led selling momentum, each attempt to break the September 28th September future stair step has failed. In fact, the Monday gained low was a full $1.80 higher than September, essentially cementing this higher stair step. These are the things, this is how liquidity providers are pricing silver. And the machines that ran gold futures into the September 1850 lows, again on Monday, they did it again on Monday, but what they did was ran into the same central bank and sovereign buy demand that was also evident in September. So gold looked quite a bit heavier. But accounting, so if we look, let's just see, take all that aside, accounting for the current pullback, the stair step in GC, which is gold futures, looks to have recommenced from exactly a $400 higher price than in March. And in SI, silver futures, exactly $12 higher than in March. And look, in this algo-driven marketplace, we don't see these round numbers as a coincidence either. Now, given the house is at best no better off than in March, but at a higher price, this potentially projects the next stair step in silver to reach 33,600 and in gold to 22,000, yes, that's coming one day, $2,251. So just projecting the same thing in about a very similar setup with a potential trying to front run a blow up. Now, look, both of these projections look extremely conservative and still under the most likely reset triggers. So, but more looking at the current footprints into the BIS election, into the BIS expiry, the election uncertainty, and now we've got vaccine hopium. Both gold and silver became fundamentally deeply oversold, because what we're seeing is this race into risk on, dump everything that's a hedge, everything's fine in la land, but essentially the machines run with it, and they've really gone to a point where it's fundamentally deeply oversold. And look, even ahead of a dovish Fed last week, there was a realization that whoever wins the election, it's going to generate massive stimulus. I mean, this is going to come in the form of massive QE, asset purchases, and probably yield curve control if necessary. Now, as a result, both gold and silver have yet to be revalued higher against a falling dollar. Now, this has already broken some of one or two of these algo correlations, and I think we see those fractures, but obviously we can see this almost muscle memory of algo muscle memory that they just continue to follow the same mantra because it worked in the past. But we see a divergence here. Now, with this realization beginning to be factored in against the short-term algo cell muscle memory, as GC and SI rose, ever larger short covering has ensued. Now, this came in alongside the very large accruing delivery obligations facing the house. Both GC and SI finally broke up above their respective downsloping 50-day moving averages. And this is the reason that gold and silver futures were hammered lower on Monday, purely that reason. Now, just to conclude, it's likely going to take until December the 8th before the election results are definitive, after which fundamentals will just start to rule again. And it matters very little for gold and silver, whoever's in power. Massive stimulus, as we say, is coming. Global debt will balloon. And relative to weakening fiat currencies, gold will do what it's done for thousands of years, which is act as a safe haven. And insiders are already securing physical gold and silver against paper gold and silver ahead of all currencies falling in value against both gold and silver. So obviously, given the huge offside undeliverable paper positions, the only answer is to revalue gold against the dollar, and this can easily be done with the stroke of a keyboard. And the consensus is still, Chris, that gold will be able to run into 2,500 and silver into 35 bucks before that trigger needs to be pulled.
So that was part one of this month's call with Andrew Maguire. Certainly a fascinating one. What stood out to me was really what he said about Standard Chartered. Essentially, if someone's paying any premium required in just lifting offers in front of December deliveries. So we'll see how that plays out. Although if you enjoyed this, you're going to love part two. Great reason to hit that subscription button, and the notification bell will be released shortly. This way you can know as soon as it is. Thanks as always for watching, and I will see you soon.